Federal interest rate hikes are crashing the U.S. stock market as recession fears loom. We're going to go over what federal interest rate hikes mean for you and us as investors in this video, so stick around. It's going to be a good one.
We at the Fed understand the hardship that high inflation is causing. We're strongly committed to bringing inflation back down, and we're moving expeditiously to do so.
An insane sell-off day in the S&P 500 as the market continues to reject off that 200-period moving average. We broke the 4,000 support level in the S&P 500 today, sending us about 20 points lower. So one thing we know is, as the federal government continues to raise interest rates, this is going to start to reel in consumer spending, and it's going to affect the price-to-earnings ratio of stocks. Now, what's important to look at here is that energy sectors were leading the way in this sell-off. The energy sector has an important correlation with the interest rate hike. Shares of energy companies are trading lower as the sector pulls back from recent gains amid raised concerns of aggressive interest rate hikes, which could pressure oil demand. One of the basic theories behind increased interest rate hikes is that it increases consumers and manufacturing costs, which reduces the amount of time and money people spend driving. Fewer people on the road correlates with less demand for oil, which can cause oil prices to drop. This is an inverse correlation, but as interest rates continue to rise, the cost of oil will go down, and this will affect energy companies' profit and earnings. And that's why you're seeing a sell-off in the energy sector right now. Now, another economic theory is that the raising of interest rates will help strengthen the dollar against other countries' currencies. When the dollar is strong, American oil companies can buy more oil with every US dollar spent, ultimately passing the savings on to those consumers and lowering the profit potential of oil companies. A strong dollar also means that less overseas business for companies like Caterpillar and tech companies that won't be able to sell as many products as they used to, lowering demand because consumers simply can't afford it while the dollar is strong. If you notice here, the euro to US dollar is almost even, and the US dollar to the pound sterling is getting there as well. A strong dollar is bad for assets because less overseas business means less company profits. When central banks like the Fed change interest rates, it has a ripple effect throughout the broader economy, and it affects stocks and bonds in different ways. In efforts to lower inflation, the Fed is taking a contractionary approach to their fiscal policy by raising interest rates. The raising of interest rates tends to negatively affect stock prices because it negatively affects earnings. That's with the exception to the financial sector. Obviously, if borrowing money costs more, then banks are going to do well when it comes to earnings. Any impact to the stock market felt by the raising of interest rates is usually felt right away. That's why you see the sell-off in the S&P 500. Meanwhile, for the rest of the economy, it may take about a year to see the widespread impact, and that's why everybody's calling for a bad recession in 2023. Now, if you believe that we're in our recession, that means that next year's earnings for the SPX should be closer to $205, all right? If you take that as a price-to-earnings multiple of 18, you get an implied SPX price of $36.90. That means we are still overvalued in the S&P 500, with a lot of downside left between $3,500 and $3,750. Now, how do federal interest rate hikes affect us as consumers? Generally, Americans rely on debt to make most purchases. And as borrowing becomes more expensive, it would begin to affect things like auto loan rates, raising the monthly payments on cars. Your credit card debts are going to get more expensive. Taking out credit card debt is going to get more expensive, but also mortgage rates get affected. Mortgage rates right now are sitting well over 5%. If you look at housing prices from about a year ago, the average home sale price was $290,000. Now, with an interest rate of 3% and a down payment, your monthly mortgage rate was sitting at about $1,650. But if you look at the average home price now of $350,000, an interest rate of 6%, after down payment, your monthly mortgage is sitting at $2,650. That's an astronomical amount compared from last year. So if you're in the market to buy a home, you're looking at that thinking, maybe I should wait. And that's what the federal government is trying to do, right? By using a contractionary fiscal policy and raising interest rates, they're trying to reel in an economy with insane inflation and insane consumer discretionary spending. Now, the federal government has to play this just right, because if they don't do enough, inflation could keep spiraling out of control and really hurting families. But if they do too much, we could see an insane recession in 2023 that will affect on a global scale. Guys, I would love to know what you think about inflation. I would love to see your comments below. Please drop a comment on this video and let me know what you think about the current state of the economy, what you think about the federal interest rate hikes, and how you feel they correlate to the US stock markets.